What's going on, guys? Kenney Conwell here, and in this video I'm going to break down the basics about the three types of income. Now, we hear all the time it's a catch line, oh man, you want to have multiple streams of income, and I don't disagree with that. But in my experience, what I've discovered through my own journey is when you focus on one, it helps you get the others. So wealth is created through concentration and focus, and wealth is preserved through smart investments and diversification. I'll repeat that. Wealth is created through concentration and focus, and it's preserved through diversification and strategic investments. So that means you've got to go all in, focus, and then once you have the money, so to speak, depending upon how you've earned the money, you can now make sure you make strategic investments to preserve the money. So the three common types of income, and there's different ones that people will talk about. Number one is earned income, right? So typically earned income is any money that you earned from a job or from a, if you're self-employed or you're an employee, that's earned income. That second type of income is, most would say, passive income, but there's different levels of passive income. I won't get too far in the weeds of it. And then the last one is portfolio income. Now, the reason why I want to make the difference between passive and portfolio is because you can still technically earn passive income and it be treated as earned income. And here's what I mean by this. Let's just say you have your normal 9-to-5 job or you're self-employed and you are the one earning the money. So you're typically trading dollars, you're trading your time for dollars, right? That's earned income, generally speaking, right? The only way you can really earn that income is if you do something in exchange for money, right? It's the most archaic way, but the majority of people use this type of income to make. However, passive income is a little different because technically passive income, you can set something in place that really makes the money, even though it's earning the money, but it's earning the money passively without you actively doing something. However, depending upon how it's being earned, it may still be taxed as earned income, but you passively earned it. Make sense? Cool. Case in point, you can become an affiliate of any type of company. You can be a brand ambassador. You can be a YouTuber. You could do all these things. So technically, YouTubing possibly could be a possible passive and earned income. But the point I'm making is you can have those dollars coming in whether you work or not. That's passive income. And depending upon if it's coming to you as an individual or going to a business entity, it's going to have to do how it's taxed. That last common type of income is portfolio income. Now, portfolio income really means I am earning money on an investment portfolio. And that investment portfolio is going to be comprised of numerous things. It can be, your portfolio can be a real estate portfolio. Your portfolio could be a portfolio of different businesses that produce cash flow for you. That portfolio could be, most commonly, a stock portfolio or a dividend portfolio. Now, the reason why I'm making this distinction to say portfolio income is because typically if you are earning income from a portfolio, it's going to be a distinct difference in terms of taxes, okay? And what I mean by this is that earned income is going to be taxed at ordinary income rates, and ordinary income rate tax tables is going to fluctuate between your AGI or your adjusted gross income. Even passive income to a degree could still be taxed as ordinary income because even though you're earning it passively, it's still subject to ordinary income tax. However, portfolio income, you have something called capital gains, and that income is completely taxed a different way. So if it's in a portfolio and you're earning this income, depending upon if you're taking a short-term or long-term capital gains tax, it's going to be completely taxed at a different rate. Case in point, if I have a portfolio that's worth $500,000 and that portfolio produces a 10% rate of return, which is phenomenal, then a 10% rate of return on my $500,000 in savings is $50,000 a year, right? Now, depending upon how that portfolio is producing that income and the type of stocks and the investment mix or whatever the case is, that's going to determine how it's taxed. And if it's taxed at capital gains rates, it's taxed cheaper. And in some cases, you can completely eliminate tax by the way you're taking the distribution or making the withdrawal from that particular account. So those are the three types of income: earned income, passive income, and portfolio income. Now, ideally, when you're starting out, you're going to want to probably heavily focus on earned income with the intent of transitioning that skill set to passive income, with the intent of strategically taking the passive income and strategically investing in some type of other portfolio, whether it's real estate, whether it's a group of businesses, or whether it's the stock market. Now, in the previous video, I talked about the importance of investing in your education. So all of those sectors are going to produce different types of results for you on the passive income side, and also on the portfolio income side. But more specifically on the portfolio income side, you're essentially having your investments work for you. Your money is working for you, and that's producing a rate of return, and then that rate of return can be taxed at a completely different rate than it would be as earned income. And that's the whole point. Now, to bring this full circle, and why I started with this by saying focus. When you focus on one thing, for example, I have a business right now. It's a financial education business, and that financial education business is focused on one thing, but that one business has allowed me to produce 13 different streams from that one. And those streams allow me to I still work in the business, so I get a paycheck, but then because I own the business, I get passive income. And then I take a portion of the passive income and the profits and I put it in investment portfolios. So I'm doing all three. You get what I'm saying? So for you, what you want to do is just focus on that one thing that's going to help you produce the other streams, and not try to do 3, 4, 5 things all at the same time, because most people are saying that, oh, I'm trying to have multiple streams. And I'm not saying that you can't, because I just broke down the different streams at a high level perspective, but you just want them to be congruent. So, it's not going to make, if you are, for example, this is popping in my head. If I am a hairstylist, it makes sense that I'll be a hairstylist and sell hair, right? And have a hair business, because it's congruent. It's not like I'm going out of my way to sell hair, right? Because I'm a stylist. It makes it easy for me to really expand that, right? However, let's just say I'm a hairstylist, and again, I'm not saying there's anything against hairstylists, but I'm trying to sell tomatoes. I'm not saying you can't sell tomatoes, and I'm not saying you can't invest in a tomato business. It's just kind of like one of those things where, is it congruent and is it in alignment with my life, because we only have a finite amount of time, right? So I don't want to belabor that point, but I think you get the picture. So essentially, when we focus on the one, it helps us create the multiple streams, and then we have to be strategic with the multiple streams, especially as it relates to tax. So if you want to learn more about how you can take your credit and your income to the next level, just below this video, I have a training where I break down what 95% of people fail to do when it comes to fixing their credit, and how you can start leveraging your income and your credit to build wealth.